They have left interest rates on hold at 0.1%. That's not really a surprise. Quantitative easing, the process whereby they're buying up government bonds, creating money, buying up government bonds, essentially kind of stimulating the economy. That's unchanged as well. They're still kind of stimulating, still buying those bonds, but not doing any more than they were doing previously. But the main focus has been on two other things. What they say about negative interest rates. Now, I know the idea of negative interest rates sounds kind of crazy. A bank potentially paying you for you having for you borrowing money from it. I mean, I struggle to get my head around it myself, but it's a reality in other parts of the world, and thus far the bank has been trying to work out whether it could implement it in this country if it needed to. And what they've said today is that they are ordering banks around the country to get ready for it within 6 months. Now, they say this shouldn't be taken as a sign that negative interest rates are in any way imminent, but they say they want the financial system to be ready for it just in case they're needed within 6 months. So that's the story on negative interest rates. As for the state of the economy, which I think is the other big thing a lot of people are focusing on, well, there have been some slight changes to their forecast, and let me just kind of go through it. I've just received it now, so this is just as I look at their numbers. They've slightly upgraded what they expect to be the final word on GDP growth, so the growth of the economy for last year, ever so slightly upgraded it, downgraded it for this year. Now, that's not a surprise because of what we're seeing right now, the lockdown that's come into place. So previously, they were talking about growth of 7.25% in this year. We're in at the moment. Now they think it's 5%. Still very strong growth, but not as strong as it was previously. And of course, not getting back to where we were before COVID-19. But then in 2022, they are expecting slightly stronger growth than they previously expected. So essentially, you're talking about weaker growth in the short term, slightly stronger growth in the medium term, and inflation, on the other hand, staying more or less close to that 2% mark. So broadly speaking, negative interest rates certainly a part of it. Banks need to get ready for it. Growth slightly weaker in the short term, slightly stronger in the longer term, and interest rates and monetary policy on hold.